Well, thank you, David. Thanks for having me back. I always enjoy these presentations. I always like to check in on all the other presenters as well. So there's a lot of good information out there. But we're going to spend a bit of time here talking about automating option strategies. These are professional types of strategies that the Wall Street pros are using and the money managers and so forth. So we're going to use some automation to help us along the way. We have got a great tool for you. We're going to do a demonstration and even demonstrate a live trade alert. So we've got these one touch responsive trade alerts that you've probably never seen before. And we do work with these professional pre-built option strategies. Our algorithm will automatically generate these for us and then present them to us so that we can choose from them. And it will also automatically manage risk and profit. And along the way, it's not just machines and AI or algos, it's real people too. So we're real people and we're here to help as well. So we're going to jump in. But before we do, remember we're speculating and there is always risk involved when you are speculating. And of course, when you're speculating, you're attempting to make money. That's the whole idea here, generate a profit. But with profit, there's always risk. So do look at our risk disclosure. If you want to read every word of that, you're more than welcome to. You can take a screenshot of that or picture of that and read everything there on your own time. But the main thing would be you should only be using risk capital when trading, and then past performance is not an indicator or guarantee of future results. Okay, a little bit about AltaVest. We are an introducing brokerage firm from 1997. So we've been doing this quite a while now. We've developed our own proprietary options trading technology, and we've traded millions of futures and options of contracts along the way. Actually, it's a photo I took years ago visiting the trading pits. That was, I think, on the closing bell, coffee, sugar, cocoa exchange. And another picture there I took as well. But anyway, we're registered with the CFTC and members of the NFA. We're located in California, so we are regulated and registered. And a little bit about me. I'm Erik Gebhard. I have my BS in Business Administration from USC. I'm a co-founder of AltaVest. I've had various securities licenses over the years. Series 6 for mutual funds, Series 63, that would be like annuities, also California insurance license. I currently have my Series 3 commodity futures license as well as a Series 65, and that's called the Investment Advisor Law Exam. And maybe you've seen us before. We sometimes get some exposure in these other venues and other events, sometimes even live in-person events. Maybe you've seen us in the past, or maybe you've seen some of our quotes on various financial periodicals in the press. Here's MarketWatch just the other day. They were asking us about the commodity markets and I think talking about gold and platinum. They quoted my partner here, Mike Armbruster, talking about physical demand for gold and so forth. So if you're not familiar with us, that's okay. Just thought I'd review a little bit of that. So you can find more about us, of course, online. But let's jump into the presentation. How many of you can relate to these three barriers to our success when it comes to trading? I think number one, to summarize, would be confusion and noise. So everything is contradictory. Everything contradicts one moment to the next. An opinion says this, another opinion says that. There's also a lot of clickbait headlines and narratives. And this is something I'm always fascinated by. All the large investment firms will give their year-end price target for the S&P 500. So this is from beginning of this year. So you can see the range, anywhere from 7,100 down to 4,450. And that's a big range, anywhere from a negative 25% return to positive 18% return. And the point I guess I'm making is, who would you choose? I don't think that's helpful at all. It's just, again, noise. And this kind of this is obviously hyperbole, but it makes the point that sometimes even looking at the technicals and the charts can be a bit overwhelming as well. This person suggesting, according to my calculations, the stock market will fluctuate. So no kidding. So anyway, that's what you might call too much info. So that's the first barrier. But how about time? if you're going to do this with particular strategies, you're going to need the time and the discipline needed to screen watch. Not many have time, people have time for this kind of approach to trading. If you can make it work, that's great. But the reality is most people, it's just not a practical approach, sitting in front of the screens all day. And here's something here. A lot of day traders spend 10 hours a day trading. It's just from a day trading website I came across, and they'll spend 4 to 5 hours actively trading during the day. And, I think that's okay if it's working for you. Don't change it if it's working. But really, from our experience, the reality is most people can't do that. We have jobs and lives and family and hobbies and things as well. And the third barrier, how about emotions? So we become our own worst enemy. Fear and greed get in the way of our own success. We ride that emotional roller coaster called the cycle of market emotions, where when things are working well, you get euphoric and you think you're pretty smart. And then when they go the wrong way, you start to get a little bit despondent, surrender, capitulate, wave that white flag, and then perhaps you get back on a little bit of a recovery, and now you kind of wipe that forehead and your brow, and you think, well, I'm kind of relieved, and now I'm optimistic again. So we want to try to stay off of that roller coaster and do what he is suggesting here, which would be to control our emotions. And that's not always easy to do. Part of the problem, of course, beyond ourselves, would be the landscape we trade in now is totally different than it was even just wow, I mean, even just 6 years ago. Your trading competition is just automation, and they have no emotion, and they have built-in controls. So 90% of the stock market US equity trading volume, according to JP Morgan, is systematic trading. So essentially that's just trading that's going to occur, for example, based on flows into ETFs and that type of thing, and based on algos and pre-programmed trading, that type of thing. So it's not necessarily, although retail trading, of course, has taken on a bigger slice of the pie, still the systematic trading is really dominating here. So if you aren't using automation, I think you're probably doing it wrong. You need some help along the way. So how about automated professional option strategies? Can that help us compete in this environment and landscape? We think the answer is yes. And with that said, so which options markets are we talking about? What markets are we going to favor and attempt to trade? Well, we're going to look at stock index options. Part of the reason for that is if you're trading an index, you don't necessarily have to track the 6,000 or more different securities and tickers. You're just trading that one index representing a lot of those individual tickers. And in particular, we like trading something here, a little bit of an oxymoron. How can mini be huge? In fact, 2.5 times larger. And what am I talking about? I'm talking about the E-mini S&P 500 stock market index. And you'll notice here that it is 2.5 times greater in terms of average daily dollar volume compared to all global ETFs around the world. So you'll see the red arrow here. So the E-mini S&P 500 contract itself is a massive, massive market. And that being the case, that means the options also have a lot of liquidity. I don't have the latest graph on this, but of course, 2025 is not over yet. We'll get that soon, I'm sure. But average daily volume over 1.5 million contracts in terms of these E-mini S&P 500 options. So there's some big advantages in trading where the money is trading. This is where the big money trades. This is where the volume is, the depth, and the liquidity. So you want to be able to trade in these liquid markets. So that's why we're in the E-mini S&P 500, as well as two other markets that are E-minis as well, the NASDAQ 100 and Russell 2000. And we'll get into more detail in just a second. But first, let's learn some Greek, a couple letters from the Greek alphabet. Some of you might have been in fraternities or sororities, so you probably know your Greek alphabet pretty well. But number one here, we're going to look at delta. That helps us determine probabilities as an options trader. So how much does the option value change with a change in the underlying index price? So that's really the definition of delta. But option traders look at it as the approximate probability of that option expiring in the money. So that's how we're going to view delta. So for example, if an option delta is 0.25, that means there's a 25% chance that option would expire in the money. And conversely, that means there's a 75% chance the option would expire worthless. Remember, delta is a number that doesn't remain static. It's always moving with the price of the underlying asset and as time moves by. And it is not the probability of a winning trade. So it's important to point that out. You can't say, for example, if you sell a option with a delta of 0.25, that means you have a 75% chance of making money on that trade. So we're going to show you more details and run through a demo here in just a second. And then the other letter is theta. It just references time or sensitivity to time. Remember, options are a, a wasting asset, as they say. They have limited life. So time decay affects the value of an option. So theta is the term used when you're looking at describing time in option speak. It's a negative number, and it's 1 day of time decay. So for example, if a premium is 10 points and the theta is negative 0.05, the next day the premium will drop to 9.95, and after that down to 9.90, and so on and so forth. So this is what it looks like here on a graph. You see the value of the option here. The value drops and drops and drops as time gets closer to zero. So as you approach time zero, especially in the last 30 days, you can see the slope of the deterioration there in the value starts to drop off. So theta decay always increases closer to the expiration date. And now let's look at how we might approach trading options. We talked a little bit about uh, the theta and the delta and so forth, but some of these larger companies and firms and institutions, they're trading options in a particular way, sort of how oftentimes an insurance company might be trading, and that would be they are paid the premiums to assume risk. So they're basically selling options, so to speak. So they're selling and manage time. They insure themselves by hedging, or that they call it reinsurance, I suppose, with in the insurance market. And they're consistent and they're patient and they have a process for doing this. And quite frankly, they just use a lot of math and probabilities for favorable long-term odds, putting those odds in their favor over the long run. So mathematical probabilities, statistics, actuarials, you name it, a lot of number crunching. That's what they're doing. And this was a piece I just found the other day. I thought it was interesting, kind of summarizing things. Top 10 reasons why selling options is better than buying options. And that's partly what we're going to demonstrate. But I highlighted just a couple here. It says here, professionalism. It's a sophisticated financial discipline, but managing risk like a professional, and its professional approach distinguishes option sellers from novice speculators. So I think we'd rather trade like a professional, wouldn't we, rather than a novice speculator. So we want to be on the correct side of this transaction. And that means we're going to look at selling options. And then here, it's often preferred by long-term investors who value consistency over high-risk speculation. So another thing to keep in mind, these are not lottery ticket types of trades. So thought that was interesting. Here's another thing. I just asked AI about option selling versus buying, and they points out all the advantages. Time decay, we just talked about that with theta. Higher probability of profit when the seller receives a premium up front. We're going to talk a bit more about that. And of course, that relates to delta. There's income generation strategies, and we're going to look at this too, market neutrality. There are opportunities in even sideways markets. So the market doesn't have to drop or it doesn't have to go up. But it can go sideways, and there are option strategies for that. And also market inefficiencies But really, the summary here is selling options can be a preferred strategy for many professionals. So I think that's a good summary by AI. And let me look here at, well, let's look at a brief few comments from an interview on CNBC. And the Wall Street pros are trading option spreads. And why is that? Because they're using theta decay to their advantage. So they collect the premium from buyers to offset the cost of the options that they're buying. So here's this interview here on CNBC, and she says here an option is buying and selling different contracts. Or I'm sorry, it's an option spread is buying and selling different contracts, and it's a common way for investors to hedge risk and volatility. And it's usually cheaper because you can offset your cost by the proceeds from different contracts. And it's used by Wall Street professionals for decades. So if Wall Street professionals are using these strategies, then I think we should too. Maybe we shouldn't try to reinvent everything. So what does this look like? What does an option strategy look like where you're collecting premium? Here's a simple example where you're selling an out-of-the-money call spread. So the red line represents the strike price of the call that you sell, and the blue line represents the strike price of the call that you buy as hedge or protection. But the net result is you still collect a net premium on this because you receive more than what you pay out. And you can see the market here kind of chopping around, moving higher along the way. You can see the expiration date here is that vertical line. But you're selling that spread and collecting the premium for that. This would be an out-of-the-money bearish call spread. And then here's a non-directional strategy. This is called an iron condor. So you have that out-of-the-money call spread, but you combine it with an out-of-the-money put spread. And then you look for the market to stay within that range between the black arrow on the high side and the low side. Just that simple. And we're going to look at how that works in just a second. And again, you collect premium for selling this out of the money call spread and the out of the money put spread. And you do this simultaneously. You don't want to leg into this or do it as one transaction after another. Do it in one transaction at one price. And here's a special strategy we developed, and we called it the Dragonfly. Kind of a clever name. And it's a non-directional strategy, and it's a variation of the Iron Condor strategy. So what you do here is, and again, I'll show more detail, but the idea is this is a call spread that you sell, and at the same time, you sell this put spread, and you can see the market here kind of chopping around. And you'll notice this blue arrow. This is when you buy back the spread according to this blue square here under a column called the RTI. That's the risk thermal indicator, and we're going to demonstrate that. But so you get a signal when to close out that trade. So essentially, you start the trade here, you sell the spread, you collect your premium, and then as time goes by, theta decay starts to work. And right around here, the algorithm says you've made enough profit on the trade. You don't have to stay in it all the way towards expiration. You can get out now and capture most of your profits and put those in your pocket and walk away. So we're going to look at this structure in a little more detail, but essentially you look for the market to stay within the range between the upper boundary and the lower boundary. But rookies, this is the thing that rookies will often do. Majority of small-time traders are buying the most basic call and put options, and they have a much lower probability of profit versus advanced strategies like option spreads. And that's from, there's another quote here. If you're only buying out of the money calls, you're likely going to lose money over time. That's from John Foley, CEO of Options AI. And so everybody in the business knows if you're only buying out of the money calls, you're likely going to lose money over time. The question that should be asked shouldn't be, can I trade options, but can I have straightforward access to the option strategies that Wall Street uses? So I agree with that, and that's what we've done here with our software demo. We're going to show you that in just a second. So be sure to stick around because we're going to look at a live trade alert and show you how to respond to those with one touch. So you receive alerts on your smart device and an email, and all you have to do is touch accept or reject, and our technology handles the rest for you. So these are professional option spreads we're talking about, and they get created and managed for you by some algorithms working their magic behind the scenes. The software, it's called Theta Trader. These are pre-built option spreads. These gentlemen here were our floor brokers that used to fill all of our S&P 500 options trades for us in Chicago. Of course, the trading pits don't exist anymore because of partly what we talked about, right? Technology and systematic trading. But anyway, I thought that was a cool picture. So the proprietary algo creates theta trades. That's what we call our daily trades. And then also you get those one-touch responsive trade alerts available to you. Bull, bear, flat market conditions, automated risk and profit tracking with a risk thermal indicator. So we're going to spend a few minutes in a demo here. So let me switch screens and just bear with me. Okay. Just making sure I'm on the right screen. Yep. Okay. So you are now looking at the dashboard for Theta Trader. And this is a demo account that I use for webinars, so forth and so forth. So let me explain the dashboard to you. Let me see here. Zoom in just a notch, maybe if that helps you out. So you'll see any active trade alerts up top, and we'll dig into that in a second. These are all the theta trades here. This is your open short position summary. Any open long positions here. This would be your account info. This is all integrated with your AltaVest trading account. So keep in mind that this technology, Theta Trader, is the platform that AltaVest developed and uses for its client base. So this is our technology. And let me show you that under the Theta Trades, you'll notice there are bullish strategies that are available and bearish strategies and then non-directional or neutral strategies. And you'll see at the moment you have E-mini S&P 500, NASDAQ 100, and Russell 2000 E-minis. So these are the indexes we're looking at. So there are trades available that are bullish and bearish for all those three markets, and only the E-mini S&P 500 and Russell mini currently have a neutral trade for today. And that's because the algo decided that's your best risk and reward. And what I can do here now is point out that, why don't we look at this here? We'll look at a dragonfly on the E-mini S&P 500, and you'll notice there are trades available anywhere from 33 to 72 days till expiration. And these are all pre-built for you. They're already pre-generated for you. And you can see the strike prices are pre-selected of the puts that are being sold and the calls that are being sold. And this is your maximum profit potential at expiration for any one of these trades. And this is called your targeted annualized return. And it's here to compare one trade or one theta trade to another. Not really to suggest you're going to have 83% returns by just placing that one trade. It's really to compare one trade to another. So we can go ahead and we'll just randomly pick. I always pick the one with the most days till expiration, or usually do on these webinars. And it'll take just a moment to generate the trade for us. Give it just a second, and then we're going to hop over and then look at the trade alert, and we'll do something with a trade simulator as well. So the first thing I like to do is look at a graph of the position, and this might help explain the dragonfly a little bit better. Let me zoom in. So you'll see the quantity you're selling 4 calls, and that's the red line, You buy 3 further out of the money calls. That's that higher blue line. And then the one blue line here is where you buy one additional call. So you sell 4 and you buy 4. So you're completely covered. These are not naked strategies. And at the same time, you have that same structure with the puts. You sell 4 and collect the premium, but you take some of that premium and you use it to buy protection by buying 3 further out of the money puts and then one closer to the money put. And the advantage to the Dragonfly here, where you buy this one closer to the money put, for example, if the market starts to decline, you own it and the delta is higher, so it increases in value more rapidly than the other 4 that you have sold that are further out of the money because their strike prices are further out of the money. And it also, theta decay doesn't impact it as negatively as well. So you have this additional level of insurance by buying this one call closer to the money and this one put closer to the money. And the strike prices, again, are all pre-selected by the algos. It's not always the same, but that's what it looks like. Now you'll see here on this table the market name, the days till expiration, put risk, call risk, commissions, capital, cash required, on and on. I won't go through everything here, but you'll see here you're selling 4 of the 60-25 puts and you're selling 4 of these 7,500 calls. So remember, we're looking at deltas. So what's the probability, according to the delta, that these puts that are being sold would expire out of the money? Well, the delta is 9.94. So that means there's over a 90% probability these options that are being sold would expire out of the money. And that's good because you're selling them to someone else and you're collecting the premium that they're paying you. Same thing with these calls. The delta is 6.45. So you've got 93.5% probability that the calls you're selling to someone else will expire out of the money. Um, and therefore, you're going to be in good shape if that's the case. So you're looking at these higher probability outcomes. That's why the algorithm has selected to sell these puts and calls. And the ones that are being bought here are for protection to hedge the position. Of course, it limits your profit potential, but you don't want unlimited risk. So that's the trade-off. And you can see the point value here. You're trying to collect 10 points on this. The cash required for a Dragonfly is just under 5,000, 4,584 in this case is your maximum profit potential at expiration. And then what you do is you go ahead and you can change the quantity if you like, and it changes all the numbers as well. You can go up or down. And then the question sometimes you might get or you might be thinking is, why would let me just change this, make it simple here. Why would I put up $4,500 for the trade? That's basically your margin deposit. That's just your allocation to the trade when my maximum is only 400 and some dollars. Well, again, it's the deltas. This is a higher probability outcome. So it has a high probability of being, favorable trade according to the math. That's the reason you do that. Um, so we'll go ahead and just, I don't know, maybe go with 5 of these. And there you go. It just shows that you've sold these 5 dragonflies because we're in a demo account. It just assumes your order is filled. All right, now let me show you. We have up here, there's something called a trade simulator, and I want to compare the Condor to the Dragonfly. So let me see if I can jump over to the simulator. Here we go. So the trade simulator is available here, right under trading, under simulator. So I've loaded a few. And you can see here's a Condor for the September in the month contract on the E-mini NASDAQ 100. Again, you're selling these and buying these calls and selling and buying these puts here simultaneously. So this is a real theta trade that would have existed on August 29, had 33 days till expiration. And we can use these buttons here to go forward and backward in time. And I'll just kind of stop it. You see the green RTI, that means good, do nothing. And you can see the P&L of the trade is getting profitable, and that's because the theta decay is working. And now it's starting to rally pretty strongly, so the P&L is getting a little negative here. because it's getting closer to your upper boundary here. And then it turns yellow, a little more elevated risk, but now you're profitable again. And then it finally turns blue, and that means take your profits and go on to the next trade. Here was the expiration date, so you're able to close this out before expiration. And I want to point out, this is important and I'll show you, but whenever your RTI turns blue, or if it turns red for too much risk, take a loss and move on, you can automate this. So you do not have to monitor it. ThetaTrader will monitor this for you, and it can all be automated so that when you get a red or a blue signal, you'll be automatically closed out of your position. So remember this here, with 5 days till expiration, this condor essentially has a profit-taking signal, and this trade works well. And that's the NASDAQ end of month for September. So let's look at the NASDAQ end of month September Dragonfly and compare it to the Condor. Sometimes the Dragonfly will act and behave differently. So it's profitable, it's green, do nothing. Gets a little yellow there, still do nothing. But it actually turned profitable and gave you a profit-taking signal here, I should say, with the blue RTI with 7 days till expiration. And if we look back, you didn't get out of this condor, you had to wait an additional 2 days to get out for a profit-taking signal. So that's sometimes the benefit of the Dragonfly. Allows you to close out a position earlier, sometimes as much as 2 weeks earlier compared to a condor. And that's just the benefit of owning this call and owning this put. So that can actually create a totally different dynamic in terms of your risk reward. And let's look at another simulation here. So here's a July end of month condor on the E-mini S&P 500. I'm not exactly sure what happens here. I kind of forgot what I put up here. Okay, so yeah, this here, scroll, whoops. This one here is a condor, and it's getting closer to the upper boundary, but finally it turns profitable with 3 days remaining. So that's your July end of month condor. So this trade worked out. Now let's look at the July end of month dragonfly. It turned profitable with 15 days remaining. So like I just said earlier, sometimes a dragonfly can get out much earlier than a condor. And that's a big advantage because now you're out of the position and you've got your capital available to place another trade. So you can see here it turned blue with 15 days till expiration compared to turning blue here with 3 days till expiration. That's the same exact in the month July expiration comparing a condor to a dragonfly. Let's look at another one here. And sometimes a condor will take a loss when a dragonfly will take a profit. And I think that's what I lined up here. So here's a losing trade on a condor. You can see it turns yellow, higher risk, orange, higher risk, then it turns red. And that says too much risk, you're losing too much money. We don't want to lose anymore, get out of the position. And again, you can automate this. So this condor ended up being a losing trade. That's the May end of month. And we'll compare that to the dragonfly. The same exact contract. Instead of a condor, we're doing a dragonfly. You get elevated risk, but you end up getting a profitable trade out of it because this call here that you own provided enough of a hedge, just enough of a protection to allow you to stay in that trade and allow it to mature and allowed theta decay to actually work. So you end up with a losing trade as a condor, but had you placed the dragonfly instead, you'd actually end up with a nice winner. So not to say dragonfly can't ever lose, because it certainly can, but it is more robust than a condor, but you do give up some profit potential for that. So it's a bit of a trade-off. And then also, let me go back, make sure we're refreshing that. You can notice here there are bullish strategies and bearish and non-directional. So it's not just non-directional strategies we're doing. We're not just only 100% of the time collecting premium, but just wanted to point out here, where did it go? Here's a strategy called a bull hedge. If you're bullish, for example, you can buy an out of the money call spread and finance it by selling an out of the money put spread. So you sell this put spread, collect the premium, and then you use it to buy this out of the money call spread. If the market rallies, then that trade should do well. So here's something on September 11. Anyway, so you get the idea there. In fact, this is kind of clever. You can see you get some profit-taking signals here. The trade's very profitable on this one day. Obviously, it's because it's moving higher, and you're long, you bought this call spread, so that gains in value as the market moves towards you. But then the next day, it quickly pulled back and expired. So if you don't take those profits sometimes and you have a chance, they can slip away from you. And now I've got a chance to show you. In fact, let me show you this real quickly. To help you along the way, we do offer our research and proprietary research, something called TradeScope. It's our daily overview and outlook with some very simple technicals. We like to keep it simple, and we try to rely more on the algorithms as well, but we do um, have our input as well because we're real people here, and we give you kind of an overview on the technicals and a market outlook of what to expect looking ahead. So that's available to you. It's all part of Theta Trader. And then also, this is how you adjust your settings in Theta Trader to automate everything. So you activate Risk Manager here, and you can choose the level of risk. I use the default level at 50, but if you wanted to be a little more aggressive, you could lower it to 38 or customize it all the way down to 25. And what I mean by that is this will allow you to essentially, if you modify the risk level from the default 50 and you change it down to say 38, what happens here is you will take um, basically just more frequent losing trades, but they won't be as large. So that's the trade-off. So I just use the default level and then you click Save Settings. And then the same thing with your profit directive, you want to activate right there and click Save Settings. So then the RTI will automatically manage everything for you. There's a great help file here too. Just want to point out in Theta Trader, all the color coding is described here, all the definitions of all the spreads, that's all described. We're not going to go through all the detail. But also, we offer a great education package here. We kind of have call it our master class for education. It's really just what you need to know, and this is not something where you spend hours and hours and hours. You're actually going to like this a lot. So we've recorded that for everyone. And then also the tutorial here on just kind of doing what I did with Theta Trader and showed you, how to place various theta trades. It's just that simple. It's just uh, clicking the button, and that's all you have to do. Now, you see this here, view the active trade alerts. So we're going to do that right in here. And here's a trade alert that came out today for the Dragonfly. This is the December end of month S&P E-mini Dragonfly spread, has 56 days till expiration. So this is what an alert would look like if you receive it on your dashboard or email or phone. And you'll notice the Dragonfly structure, again, selling the 4 calls, buying the 3 for protection, and buying 1 further closer to the money for additional protection. And then the same structure with the puts. And this is important to point out. The quantity is all pre-selected for you, and that's based off of your account size, what your cash balance is, and other trades in your account as well in terms of the alerts that you receive. So every alert is really tailored to you. If you already have this same position in your account, you would not receive this alert. It's redundant and it would be what they call concentration risk. So keep in mind, every alert is going to be individualized and tailored to you and your particular situation with your account. And so you can adjust the quantity lower so you can reduce the level of exposure, but you can't increase it and add risk. So this came in at 8 based on the account balance and so forth in this demo account. And you can see here all the details by hovering over. You're trying to get it for 8.95 points. There's the premium being collected and the cash required. And this is all basically net of all commissions and fees, I should mention as well. It has 56 days till expiration. So I'll go ahead and just change it just to be different. We'll sell 7 of these and we'll go ahead and accept that alert. And there you go. Just sold 7 of those dragonflies. It just assumes you're filled as a demo account. All right, so that's a lot of information, but let me show you how the alert works on your phone, which the vast majority of people, I think, respond to the alert via their phone because, most of us have a smartphone with us at some point during the day. And let me make sure I'm covering everything here that I wanted to cover. Okay, and then I can refresh it, and then you'll see that alert because I accepted it. Will disappear after you accept it. So you can't place that same alert uh, accidentally twice or what have you. And I should also point out that if you notice one other thing too, the dashboard is a good summary of your account right here at a glance. You'll notice the open bot positions typically are negative right now, and open short positions, most are positive or close to it. And again, that's makes sense, doesn't it? Because long option strategies have a much lower probability or likelihood of working out for the trader. And here's the positions here. You can look at all your closed positions, and I think here we go. I did put them up here. So now remember, this is just a demo account. So it's just me placing trades every week via webinars and just kind of randomly placing trades. And then I have the automated exit set up. So you can see on this page, there are 20 trades, 15 winners, 5 losers. 14 of the trades are short option spreads where you collect premium. So there were 11 winners and 3 losers. And then 6 of those positions were long strategies where you actually paid money or a debit spread. So when you pay, you're calling that a debit spread. When you sell, you call it a credit spread. But this kind of makes sense. This is kind of a good summary in some ways of how the idea of selling options has a much higher probability of favorable outcome than just buying options. And then so there's 20 trades on this one page. So, and then if you want to look at the next 20, you could go this way. So again, you can see 14 winners, 6 losers, and 12 out of 12 short option strategies were winners. And let's see, go to the third page. So this is going back to, let's see here, entry date to July. So you can just kind of see all the demo trades here. And again, you've got 16 winners, 4 losers, but the short positions were 15 winners and 0 losers. And then we can go just one more. So you can see there are going to be streaks where you can do very, very well with these short option strategies. And then, you'll notice too that the winners oftentimes are kind of like taking small bites at the apple. You're not going to have these, 1000% grand slam trades when you're selling option premium like this. So it's a lot of base hits, as they say, if you want to use the baseball vernacular, and you use the risk controls of the red RTI to take you out of trades that are losing money. You can see a loser here and here as well. But just kind of giving you an example of how this demo account looks and how it kind of represents what we talked about statistically speaking. So you're looking at longer term favorable odds. That's what we like. And you have to be willing as well to set that risk control up and take losses when things, are not going in your favor. You don't want to be a bag holder. All right, well, let me switch screens real quick, and then let me show you back to the presentation. So this is how you could respond to those trade alerts with one touch. And I should also mention In just a bit, I'll have some time, I'm sure, to answer a few questions. So be sure to ask questions in the chat. So these are the one-touch alerts. These are live alerts. So these are integrated with your AltaVest trading account. So all you do is touch accept if you want to place that order. So here's what it looks like. I think it's my daughter holding that. But anyway, you'll just get that alert. You'll see the screen. You can set the trade by accepting it or rejecting it. And this is what it looks like on your phone when you initially receive the alert. You get a message, and you just touch that hyperlink. Let's give it a try. And then that will just bounce you right over to the alert page. So you can see the alert there described for you. That happens to be a dragonfly, 66 days till expiration. That should look somewhat familiar to you, that dragonfly structure. Similar to a condor, just with an extra put and a call. You can see the quantity pre-selected for you. And you can see the premium being collected, the cash required. You can change the quantity if you want. You could lower it if you would like. Cannot increase it. And then you like what you see, you want to accept it, you just touch accept, and the order is submitted for you. It's just that simple. So these alerts are very convenient and user-friendly, allowing you access to these really otherwise complex, complicated, sophisticated strategies that professionals use. We can kind of put them right at your fingertips and deliver them right to you. So here's how to get started with ThetaTrader. The ThetaTrader software is everything you just saw in the demo here. So that includes all the theta trades, the risk thermal indicator, and the trade simulator. So remember, the RTI is the automation for the risk and profit taking. The trade simulator that you saw some examples. You don't have to use that play button. You can go directly to the end of each trade with just one click. But just for demonstration purposes, I used the played button. So valued over $3,588 on the ThetaTrader software alone. But you do also get the one-touch trade alerts. What just happened here, folks? Well, that's odd. I think you're just looking at a blank screen right now, so I apologize for that. Let me see if I can't get this open again. My presentation just quit on me. Okay. Let me see if I can get back to where I was. I don't know why that happened, but we'll get through it. I'm not going to panic if you don't mind. Let me just kind of get back to where I was. Okay, I'm working on it, folks. Give me 1 second here. Show. Well, that's funny. We're just going to have to go through. It won't let me start back where I was, but that's okay. We'll get through these quickly. Yeah, that is unusual. The program just shut down on me, but we will get right back where we were and just give me 10 seconds here. This is real life, folks. We'll deal with it. Okay, so we're back to the Theta Trader presentation here on how to get involved in using Theta Trader. So thanks for your patience. So all of the Theta Trader software and these alerts that we talked about valued at over $4,464. So that's all included. So just to summarize, Theta Trader and the trade alerts, over $8,000. Then private coaching, I mentioned that earlier. We are real people and we attend events and we do all these things online as well. So we're real people and we're all licensed and experienced, and we work with you. We work with our clients one-on-one, and we're ready to help you too. How much is that worth? Well, a lot of trading coaches are retail anywhere from $5,000 to $15,000 for 6 to 12 months of consulting. But with Theta Trader, once you're involved with us, you can work with us really as much as you would like one-on-one. I think the value is much higher than 10,000 to have that access to us. Kind of have a co-pilot who's someone who's licensed and experienced to discuss your account and your trade strategy and what you want to do moving forward and your goals and so forth. So the Theta Trader technology, the trade alerts, the private coaching valued at over $18,000. And then keep in mind, we do the TradeScope newsletter as our reaching. We reach out to you with TradeScope every day, and that's just really 1 to 2 pages, real quick read, very convenient and useful. Then we have the education. We call it our Futures and Options Master Class. That's all embedded. That's all part of Theta Trader as well. Some of the chapters here, the 6 chapters, I believe. Oops, sorry, that you have access to. You don't have to get into all the details there, but we just tell you what you really need to know, no extra nonsense or fluff, and people like using that as a resource. So evaluated over almost $2,000 for that Futures and Options Master Class, included with TradeScope, the daily research, almost a $3,000 value. And we have those online tutorials as well. I think I briefly told you about that. So the Theta Trader software, the Theta Trader trade alerts, those interactive live trade alerts, the private coaching, the masterclass for research and education, futures and options, over $21,000 value. So that's our professional options package for Theta Trader. But of course, we're not going to charge you that. And we would do live events, in-person events, and we would charge $4,000. So we're not going to charge you that either. And we've done other webinars at $997, but we're making this available. Timing Research, one payment, only $597. That's a lifetime membership. And here is the link, cf.altivest.com/TR for Timing Research. Or you can just take an image of the code there, QR code. It's only one payment, and that's a lifetime subscription to Theta Trader. So it's a great deal, folks, and you do have a 30-day money-back guarantee. So if 29 days from now you decide it's not for you, that's okay. We'll just refund your membership fee. That is not a problem. How about a free membership? People like to take advantage of this. Who doesn't like something for free? You have $100,000 or more in your account within 30 days, and you'll get a 100% rebate. If you have 50,000 and above, you get a 50% rebate. So people say, do I still get that rebate? I've got one more day, and it's like, okay. So, yes, take advantage of that. And just to kind of summarize advantages in trading the E-mini options, you've got that large market share, so densely packed strike prices and daily expirations, so you get granularity in coverage. So it's a big advantage. And the cost savings here too on the E-minis, higher volume and superior execution, execution according to the CME group. You have a cost savings of $4 to $15 per contract when you're trading ES options compared to SPX. So what they're telling you is you've got so much volume and liquidity that the bid-ask spread is very, very small, very tight on these options. And remember, these are covered spreads, so these are not unlimited risk. And here's a big advantage, folks, no margin calls. When your risk is covered in advance, you're not going to be forced out of positions if you're trading covered spreads. So no margin calls. You're not going to get a call there that says margin, just like this woman here says, who is margin and why does she keep calling you? So she wasn't too happy about that. So no margin calls with covered option strategies. And there's no pattern day trading restrictions when you're trading with us. So if you weren't aware of that, basically it's a pattern day trader, someone who executes 4 or more day trades within 5 business days in the same account. And once the SEC notifies or gets, I guess you could say, notes that you're a day trader, pattern day trader, uh, I'm not sure how you unwind that. I don't know if anyone knows, but so you get additional regulatory scrutiny. And the big problem is if your account drops below 25 grand, you are prohibited from making further day trades until you bring your balance back up. So we don't have that with futures options. There's tax efficiency, a big advantage when you trade options and futures with us. So, and what I mean by that is you are getting treated differently. 60% of the gains are taxed at the capital gains rate versus 40% taxed at your personal rate. That's according to IRS section 1256. Here's a mathematical example here. Tax savings versus individual stocks. I won't go into the details, but the bottom line is if 60% of your gains are taxed at the lower capital gains rate, then you can imagine the big advantage in tax efficiency there. And then there's no more itemizing. So no more need to itemize each trade. You just get your 1099 and has your P&L for the year, and you get that one number, and that's all you do and all you need for your tax preparation. But always consult your tax attorney or advisor, of course. And then you can use your self-directed IRA to trade with us as well. We work with Equity Institutional Services, Equity Trust. They have 71 billion. We just did a presentation with them actually a month or two back. That was a lot of fun. But absolutely, self-directed IRA, that's a very popular thing to do. And then keep in mind too, we're a full service, so we can trade any commodity futures and options market. Just happened to focus today on Theta Trader and the E-mini index options in particular, but we have certainly clients that are trading, you name it, agriculture markets, a lot of gold, platinum, silver, energies, grains, all the usual stuff. So we can do anything, not just what I showed you in Theta Trader, although that is something we love and kind of have a specialty in the options premium or options collecting premium market. So diversify your portfolio with alternatives. Remember, these are automated, non-correlated option strategies you can use to hedge or speculate in your own stock portfolio. I think it makes a lot of sense. So to summarize, and we have a few minutes here for a couple questions, I think. To summarize the benefits of Theta Trader, remember these strategies are flexible for any market condition. So you don't have to be in a big bull market to have strategies that you can apply. You can have a consolidating market, and there are plenty of strategies for that, like we saw with the Dragonfly or even the Condor. And in fact, even if a market's moving higher or lower, the Dragonflies and the Condors can work well too. It's just they fall under pressure if you get a rapid move of large magnitude that is persistent. So you get a 1 or 2% drop each day for a week in an index, then you're going to come under pressure in some of these non-directional strategies. But these are professional premium collection strategies that have been simplified and that are now accessible to you. You have the convenience with the automation and those trade alerts in particular. You can diversify or hedge as well. You've got an investment portfolio that might just be relying on a bull market, and these strategies do not rely on only a bull market. You get the tax efficiency and the tax advantage status, of course, those responsive trade alerts, and then no pattern day trader restrictions as well. So I know that's a lot of information, and there's probably a few questions out there, and I'll leave this up as the last slide here. And I think there's a few minutes for some questions. And let's see here. Let me check that. Someone said grow Trojans. I missed that earlier. Yeah, absolutely. Yeah, that was a good time. Took my daughter to a football game not too long ago. Okay, so someone's asking about disadvantages. Well, of course, there's always a hole in every strategy or every approach. There's always a trade-off. So it's just no secret. If you're selling options, then yeah, you're not going to make a grand slam trade. You're not going to be one of those stories that you read in the paper where someone, you know, bought $100,000 worth of call options on some penny stock that no one ever heard of, and it just exploded in value, and now that person's a millionaire. It's not going to happen to you overnight when you sell option premium. That's just too much volatility, too big of a drawdown, too much low probability outcome with that type of approach. It's just not really a professional approach to trading. All right, and yes, someone said selling naked calls is dangerous. Absolutely. That's why we don't do that. So as I mentioned, we're only doing coverage strategies. All right. And let's see if there's any other questions. Some people ask about Canada. We always get people asking, can I do this if I'm in Canada? Unfortunately, we cannot accept most Canadian accounts, but do call us and ask us anyway, depending where you're located. If you're out of the country, if this is something that you can do. A lot of clients in the UK and Australia like to work with us, and the trade alerts work well, depending on, it's not dependent really on your time zone as much, because you can simply respond to an alert so easily. You don't have to necessarily be in front of your big desktop screen and have your workstation out or anything like that. So let's see if there's any other questions. People ask about trading in terms of the account size. You notice each Dragonfly has a margin of about 5,000. So we suggest 25 to 50,000 as an account size if you want to have multiple Dragonflies going at the same time. And if there's anything else, let me know. But I don't think I see any other questions, but let me know otherwise. But that'll do it. I'm ready to wrap it up if there's no other questions.